All right, buckle up, we've got a wild one today. The stock market is acting like it had 3 Red Bulls and a bad idea. The Fed is dropping hints. One company is basically speed-running bankruptcy, and 2 tickers just lit up the charts like it's 4th of July. And trust me, you do not want to miss what's happening next. Let's run it. So the Federal Reserve just pulled a classic, we're not saying anything, but we're saying something moment today. Jerome Powell tiptoed around the mic like he was defusing a bomb. You could almost see him doing the finger-pointing, don't panic dance. Here's the key takeaway. He didn't officially say rates are coming down, but he also didn't say they're staying high. Inflation is cooling, unemployment is stable, and consumer spending is still holding. That's basically the Fed saying, we might cut, but don't get your hopes up yet. For investors, this is huge. Why? Because every word from Powell shifts trillions in algos, ETFs, and institutional flows. A slight hint of rate cuts and growth stocks could sprint. No hint, safe haven plays like bonds and gold spike. Wall Street reacted immediately. You could practically watch algos slam the buy button like it was Black Friday at Walmart. Tech, AI, and EV stocks got a little boost, while high-yield debt ticked lower. Investor takeaway, this is a coiled spring moment. The market wants to run, but it's waiting for Powell's official signal. If you're holding cash, now's the time to start watching where momentum is gathering, because the second Powell leans hawkish or dovish, we could see triple-digit moves in some sectors. Next up, the funeral bells are officially ringing for Cracker Barrel. And no, I'm not being dramatic, just look at this chart. It's a full-on ski slope, and we're not talking bunny hills. Here's the breakdown for investors. Revenue is tanking, same-store sales are shrinking faster than a puddle in the desert, and cash burn. Off the charts, they're bleeding money like it's going out of style, and it doesn't look like help is coming anytime soon. Earnings were so brutal that the CEO probably read the report, slammed the laptop shut, and went for a long walk. Net losses are widening, margins are collapsing, and debt. Yeah, it's piling up faster than you can say bailout. Analyst reactions are brutal, price targets are being slashed, and insider selling has been quietly climbing. If you're holding this stock, you need a solid exit plan. And it's not just numbers, foot traffic is down, consumer interest is fading, and the market sentiment is pure red. This company's survival now depends on either a miracle or a major restructuring. So here's the key takeaway for investors. If you're looking for a turnaround play, this might be more smoke than fire. Watch for liquidity reports, bankruptcy whispers, or any CEO moves, because one wrong step, and this thing could freefall even further. Flip the universe, we're now in NVIDIA territory. And oh boy, this earnings report was basically a cheat code for the stock market. Here's the scoop. Revenue came in at $26.3 billion, smashing estimates by plus 15%. EPS, $2.70, another beat. And guidance. NVIDIA basically told Wall Street, we're just getting warmed up. Why does this matter for investors? Because NVIDIA isn't just selling GPUs, they're powering AI, data centers, and next-gen gaming. The market is looking at the next 3-5 years, and honestly, it's making everyone else in tech look like they showed up to the party late. And get this, analysts aren't just upgrading price targets, they're going full Everest climb mode. Some even projecting $1,200 plus per share. That's not hype, that's math meeting market mania. Volume was insane, options blew up, and retail investors, they're leaning in harder than ever. This is the type of earnings that makes long-term holders sit back, grin, and whisper, "Yep, I'm him." Pro tip for investors, watch the AI adoption numbers, data center demand, and GPU supply chains. These are the secret sauce that's keeping NVIDIA's rocket fueled. And if you're thinking about entry points, patience is key. Momentum is real, but don't chase the rocket after liftoff. Watch dips, monitor guidance, and ride the AI wave. All right, strap in, here comes the spicy one, beat. This thing woke up, chose violence, and ripped harder than my jeans after Thanksgiving dinner. Let's break it down for you. Beat closed at $2.12 today, up 36%, and check this. Over the last 5 days, it's up nearly plus 194%. Volume is screaming, 159 million shares changing hands. That's not normal, that's people noticing. What's fueling this madness? Heartbeam just announced their FDA breakthrough for remote cardiac monitoring devices, and the market is losing it. Analysts are buzzing. Retail traders are tweeting nonstop. Shorts, they're hiding in the corner crying into their portfolios. This is exactly the type of stock that can flip from zero to hero in hours, but listen, it's not a guaranteed rocket. Risk is real. You're betting on hype meeting fundamentals. For investors looking for a play, watch the next press releases, partnerships, and any trading volume surges. Those are the triggers that can send this thing even higher. Pro tip, keep beat on your radar like a hawk, but don't get greedy. Small wins in microcaps are how you protect your stack while riding volatility. And here's the kicker, this isn't just hype. Heartbeam's device adoption, FDA pipeline, and recurring revenue potential actually make this one worth watching beyond the meme spikes. If you want daily US stock breakdowns in under 8 minutes, faceless, fast, and to the point, hit that subscribe button. No fluff, no drama, just real updates you can actually use. See you tomorrow, market's gonna be spicy.